Hi everyone, welcome to VittEdge. Clarity, conviction, capital. Here we simplify the markets, no noise, no confusion, just sharp insights backed by logic and data. Let's decode the markets together. Budget 2026 is not just about numbers, it is about direction. In this video, we will decode three things: sector impact, policy signals, and investment strategy. Which sectors can benefit? Where is the government focus shifting? And most importantly, how should investors position themselves? Let's break it down. Union Budget 2026. Let's quickly understand the key announcements. First, capital expenditure at 12.2 lakh crore. That means strong infrastructure push. Second, fiscal deficit target at around 4.3% of GDP. So government is focusing on stability. Third, clear focus on infrastructure and manufacturing. Growth-oriented approach. Income tax relief, very limited. But big boost to digital, defense and strategic sectors. So overall, growth with discipline. This is a clear infrastructure budget. Government spending is at record highs. Capital expenditure is the key focus. New freight corridors are being accelerated. High-speed rail projects get priority funding. National waterways are expanding. Logistics efficiency is improving. Connectivity across India is strengthening. This means one thing: infra companies may see strong order inflows: cement, steel, rail, logistics, direct beneficiaries. Infra spending acts as a long-term growth engine. Short-term volatility is possible, but structurally, this is bullish for capital goods. This budget clearly strengthens Make in India 2.0. Semiconductor mission gets expansion. India wants to become a serious chip manufacturing hub. 40,000 crore rupees allocated for electronics manufacturing. That is a big push for domestic production. Support also extended to textiles and container manufacturing. Import substitution is now a clear priority. The message is simple: India wants to manufacture more, import less, and build strategic strength. This is long-term structural growth. This is not a short-term story. This is a structural theme. Government is giving tax incentives for digital and data infrastructure. India wants to become a global cloud hub, not just an IT services hub. AI adoption is rising. That means more servers, more storage, more computing power. Data centers need massive electricity. They need land. They need cooling systems. So who benefits? Companies like E2E Networks, cloud and AI infrastructure providers, Netweb technologies, high-performance computing and server solutions, and even real estate players like Anant with large land parcels suited for data center development. This theme spreads across sectors: power, real estate, hardware, digital infrastructure. This is a 10 to 15-year opportunity, not a one-quarter trade. Digital infrastructure is becoming India's next growth engine. Budget day means volatility. Markets reacted sharply at first. We saw quick swings up and down. Higher trading costs also impacted sentiment, especially with STT changes. Broad-based selling was visible. Many sectors corrected together. Traders turned cautious in the short term. But remember this: short-term volatility does not cancel long-term themes. Infrastructure, manufacturing, digital, structural stories are still intact. Smart investors focus beyond the noise. Now, while the overall direction looks growth-oriented, let's also understand what could be negative from a market perspective. First, there is no direct income tax relief. Many investors were expecting personal tax cuts to boost disposable income and consumption, but that hasn't materialized in a meaningful way. Second, we may see higher trading costs. Any increase in transaction-related levies or tighter market regulations could slightly impact short-term trading sentiment. Third, the budget doesn't immediately trigger a strong consumption boost. The focus is clearly on long-term capital expenditure rather than short-term demand stimulus. And finally, in the near term, there could be liquidity pressure. Higher government borrowing or tighter financial conditions can create temporary stress in the system. So, while the long term vision remains constructive, investors should stay aware of these short term headwinds and position portfolios accordingly. So, what should investors do now? First, focus on structural growth themes. Think long term, not short term noise. Second, avoid over leveraged speculative stocks. High debt, high risk, no need. Third, prefer strong infra and manufacturing leaders. Budget push is clearly visible here. Fourth, digital and data infrastructure is a long-term story. India's data consumption is only going up. And finally, stay patient. Do not panic on short-term volatility. Markets react emotionally, but wealth is created rationally. Stick to quality, stay disciplined, and think long-term. Thank you for watching VittEdge. Subscribe for clear insights and strong conviction. Watch next and stay ahead. VittEdge. Clarity, conviction, capital.